Two friends start investing on the same day. Rohit chooses what everyone calls safe money. He puts 10 lakh into corporate bonds offering 9% interest. Ananya decides to take what people call risky money. She invests 10 lakh into an equity index fund linked to the Nifty 50, which has historically returned around 12% per year. Fast forward 25 years, Rohit's 10 lakh becomes roughly 86 lakh. Ananya's 10 lakh becomes more than 2.5 crore. Now here's the twist. Rohit's bonds looked stable on paper, but a few years down the line, one of the companies he invested in got downgraded and he had to sell his bonds at a loss. Meanwhile, Ananya just kept reinvesting her dividends. This is the silent truth most investors miss. Corporate bonds are not risk-free. Their returns are fixed, but their risk is not. Today, let's unpack why. If you have a long-term investment horizon, you should be very cautious about overloading your portfolio with corporate bonds and fixed return instruments. The nature of corporate bonds. A corporate bond is essentially a loan that you give to a company. In exchange, the company promises to pay you interest, called a coupon, and return your principal at the end of the term. The idea sounds simple and safe, right? But there's a catch. Corporate bonds carry a degree of credit risk, the possibility that the company may default or delay payments. To help investors judge this risk, credit rating agencies assign grades like TKA, AAA, BBB, and so on. A bond-rated PAYPILE is considered the safest among corporate bonds, while a BBB-rated bond is one step away from becoming junk. The higher the risk, the higher the interest rate the company offers. But higher interest is not a gift, it's compensation for higher default probability. This is where many investors make a mistake. They chase yield without understanding that behind every extra percentage point of interest, there's an extra layer of uncertainty. Unlike government bonds or fixed deposits backed by sovereign or banking guarantees, corporate bonds are only as safe as the company that issued them. In finance, there's a term called the risk-free rate. It's the rate of return on investments that have zero chance of default. In India, that benchmark comes from Government of India bonds or bank fixed deposits insured by the Deposit Insurance and Credit Guarantee Corporation (DICGC) up to certain limits. When you invest in these instruments, your capital is practically guaranteed. The government can always print more money to repay you, and banks are tightly regulated by the RBI. However, this safety comes at a cost. The returns are modest, usually between 6% and 7%. They protect your money but don't multiply it. Corporate bonds sit somewhere between the risk-free world of government securities and the high-growth world of equities. They promise more return than FDs, but that extra comes with risk that doesn't always show up until it's too late. The illusion of fixed returns. Many investors buy corporate bonds believing that the fixed interest makes them safe, but what's often ignored is that the return might be fixed while the risk is floating. When you buy a corporate bond, you're entering into a contract that assumes the company will remain solvent for the duration of that bond, maybe 5, 10, or even 15 years. But what if interest rates rise sharply during that time? The value of your bond drops because new bonds in the market now offer higher yields. If you try to sell early, you take a loss. What if the company's credit rating falls? Even if it doesn't default, investors will demand a higher yield and your existing bond will again lose market value. And in the worst case scenario, what if the company defaults altogether? We've seen this happen with ILNFS, DHFL, and several smaller issuers. Even a small 1% default risk becomes devastating when your portfolio is concentrated. So while your interest payments look steady, the value of your bond and the certainty of getting your principal back are not fixed at all. Fixed return versus fixed risk, that is certainty. Let's talk about one of the most misunderstood concepts in investing, the difference between fixed return and fixed risk. When you invest in a fixed deposit or a government bond, both your return and your risk are fixed. You know exactly how much you'll get, and you can be nearly certain you'll receive it. That's why we call these risk-free assets. But corporate bonds are different. They offer fixed returns, yes, but their risk is variable. It changes based on the issuer's financial health, interest rate movements, and even broader economic conditions. It's like buying a ticket that says guaranteed show, but only if the theater doesn't shut down halfway. A corporate bond might offer 9% while the government bond offers 7%, but that extra 2% isn't free money. It's the price of uncertainty. If even one bond in your portfolio defaults, years of interest income can vanish overnight. The long-term trap. Now let's consider what happens if your investment horizon is long, say 15, 20 or 25 years. Corporate bonds may seem stable in the short term, but they don't benefit from economic growth the way equities do. A company can grow tenfold in earnings and stockholders capture that upside. Bondholders don't. They just keep getting their 9%. Meanwhile, inflation keeps rising. A bond paying 9% in a world where inflation averages 6% might look fine on paper. But your real return, what you can actually buy with that money, is only 3%. If you hold a long-term portfolio that's heavily tilted toward corporate bonds, you're effectively locking yourself into a slow erosion of purchasing power. You're preserving nominal wealth but losing real wealth. So in a strange way, the safe investor becomes the one who quietly falls behind, while the risky investor who owns businesses through equities grows ahead of inflation and prosperity. This doesn't mean you should avoid corporate bonds entirely. They can play a useful role, offering predictable cash flows and diversification, but they should be used carefully, especially if your goal is long-term growth. A few high-quality AA-rated corporate bonds can help reduce volatility in your portfolio. But going overboard just because the returns look stable can be dangerous. The stability is often temporary, and the risk, though hidden, can be catastrophic when it appears. In contrast, government bonds and fixed deposits remain the foundation of capital protection, but they're not engines of wealth creation. Over decades, that role belongs to equities, the ownership assets that grow as the economy grows. So the next time you hear about a safe 9% corporate bond, pause for a moment and ask, what is that 9% really paying me for? Because in investing, there's no such thing as fixed return without risk. Safety isn't about stability on paper. It's about ensuring your money grows faster than inflation, and that's something no fixed return instrument can guarantee over the long run. If you found this breakdown helpful, make sure to like this video, share it with someone chasing high yields, and subscribe for more deep dive content on wealth building and smart investing.